I've been very open, honest, transparent about the fact that I would consider myself a dividend growth investor, considering I invest into different dividend paying stocks and ETFs that pay dividends from day one, but also have the potential to pay more and more in cash flow long term. But along with my dividend growth strategy, I also like to twist in to sprinkle in some more income focused, cash flow focused investment vehicles, because my strategy, my goal as of right now is to get my monthly total dividend income up as much as possible, as fast as possible, in a safe manner that's not going to completely ruin my portfolio. Now in this video specifically, we're going to go over 3 of my favorite ultra high yielding ETFs that yield much higher than most stocks or ETFs across the entire markets. We're going to go over what these ETFs are, how they work, and why I personally think these cash flow generating machines are relatively safe, especially for how much income they spit out to investors on a monthly basis. So if you're a dividend investor focused on cash flow and want more income from day one, make sure to stick around, drop a like down below, and let's get right into the first ETF. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the markets. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. So the first ultra high yielding dividend ETF that I've been buying a little bit more as of recently and I've had my eyes on for a while is FEPI, or the Rex Fein Innovation Equity Premium Income ETF. Now it says right here, as of last, the distribution rate currently is 25.2%. So I was not lying when I said these ETFs we're going to go through yield a lot more than most other stocks and ETFs across the entire market. Now, FEPI's objective is pretty simple, which is why I like this ETF quite a bit. It's to own big tech, some of the most popular names that you and I know and love, but with their right cover calls on the bucket of stocks. Now, before you say what's the point of that, you could of course buy your own shares and right cover calls in them. Of course, you could do that on your own and not pay a price expense ratio, but buying some of these big tech names in lots of 100, writing cover calls, doing the whole thing would not only be pretty difficult, especially for newer investors, but also could be pretty pricey. Now, by doing this, it enhances income potential, which it definitely has, at least so far with this fund since inception. And speaking of inception, this fund has only been around since October of last year, so we do have a little bit of data to go off of, but keep in mind it's relatively new. Now, before we look at this fund's performance, let's look at the holdings. It says FEPI Holdings, the Fein Innovation Index, is equally weighted and includes 15 highly liquid stocks focused on building tomorrow's technology today. The index rebalances monthly and reconstitutes quarterly. So this is very actively managed. This fund is going to be moving around, moving and shaking quite a bit. But as of right now, these top 15 tech stocks are equally weighted, which means they more or less have all the same amount of holdings within the fund. We're talking about names like Tesla, AMD, Apple, Intel, CRM, Amazon, etc., etc. So I know you're probably saying next, well, show me the money, show me exactly how much this ETF has paid in dividends, at least since inception. And this ETF has been actually very consistent, around $1.10 to $1.20 every single month, more or less, maybe $1.15 on average since this fund's inception. And this is for an ETF that cost only $56 more or less as of right now per share. This means that investors could of course get around a 20+% yield if of course this ETF keeps doing what it has been doing, at least historically. Which, on top of the fact that this ETF has an awesome strategy, has paid dividends consistently, this ETF is actually up also on the max time frame, 9.7%, which is almost unheard of, especially for an ETF that yields north of 20%. Now, FEPI has an expense ratio of 0.65%, which I honestly find very cheap, especially for how actively managed this ETF is. If you're looking for ultra high yield, definitely read more about this one. It definitely interests me. The next ultra high yielding ETF that's one of my favorites, I've been buying this one for a while now and been getting paid dividends every single month, is SVOL, the Simplify Volatility Premium ETF. Now it says right here on the website, on the Simplify ETF website, the Simplify Volatility Premium ETF, or SVOL, seeks to provide the investment results before fees and expenses that corresponds to approximately 1/5 to 3/10 the inverse performance of the CBOE, or the Volatility Short-Term Futures Index, while also seeking to mitigate extreme volatility. Now, SVOL is actually basically flat on the 1-year time frame, which is a little bit disappointing for investors like myself, but because this ETF, at least trailing 12 months, has paid around 16% yield, I don't mind this ETF being down a percentage or two. Another negative about SVOL is probably the expense ratio at 1.16%. It's rather expensive to hold on to, but again, if you're getting paid, say 12, 14, 16, 18% yield consistently, which consistency has been a thing for SVOL, 30 cents per share per month ever since July last year, so around a year ago, this ETF has more or less traded sideways and paid a nice juicy dividend every single month on time, which I'm not complaining about. SVOL for me personally is sort of an alternative investment and sort of a different strategy that I would never make a large portion of my overall portfolio, but the yield is there, the performance is there also. This one is definitely one to look into. Another one of my favorite ultra high yielding ETFs, which I've been buying a lot more even in the last week or so, is QQQI, or the NEOS Nasdaq 100 High Income ETF. Now this ETF has a 14.48% distribution yield, so up there with some of the higher yielding assets. QQQI has a 0.68% expense ratio, so it is pretty expensive to hold on to, but again, for this sort of ETF, it's sort of to be expected. Now, the target benefits of this strategy, let's go through it. It says, number one, the fund seeks to distribute high monthly income generated from investing in the constituents of the NASDAQ index and implementing a data-driven call option strategy. Number two, it says actively managed by NEOS, the fund seeks to take advantage of tax loss harvesting opportunities in addition to utilizing NDX index options classified as Section 1256 contracts, which are subject to lower 60/40 tax rates. Now, lastly, the fund utilizes a call option strategy that may include both sold and purchased NDX index options, which provide the opportunity for upside capture in rising equity markets. Now, this ETF is currently trading in the low 50s and is up around 5.75% on the max time frame, and this ETF has only been trading since around January of this year. But for a $53 ETF that's been paying 62 cents, 61 cents, 59 cents on a monthly basis, this ETF is yielding a ton for investors and has a rock solid strategy, which is why I personally have been adding some of this to my portfolio over the last several trading days. Now, I know at the beginning of the video, I shared that I personally feel like all these ultra high yielding ETFs are relatively safe. And I say this because a lot of ETFs or stocks for that matter that yield maybe a lot more than 10%, for the most part, in my opinion, are things you want to stay away from. But at least year to date, just going off of year to date, total return, which is dividends plus price return included, every single one of these ETFs are not only green, but have all returned at least 8% or more, which is not bad whatsoever, especially for the nature of these sort of ETFs. QQQI year to date is up 12%, SVOL is up 8%, and FEPI is up 14% year to date. So again, are there better assets out there to invest into long term? There might be, and would I personally ever make any one of these ETFs a large portion of my portfolio? I personally wouldn't, but are these good cash flow generating ETFs to sprinkle in here and there for my personal portfolio because of my personal strategy? I 100% think yes. But now lastly, most importantly, I want to hear from you guys down below. Out of FEPI, SVOL, and QQQI, if you could only invest in one of these, let me know down below which one it would be. Drop the ticker symbol in the comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Dividend investing ebook and the new dividend tracker today. It's the first link in my description. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.